Yeah, so I think we have like the slot right before lunch. So I think we're keeping you between that, between this and that, which CB Insights always does a very good job at lunch, I might say so, at their conferences. So you know what? Let's get right to it. So you are at Bain Capital Ventures, and you have pretty much always focused on fintech. So you've seen some of the evolution that we have over the past, like what, 5-10 years in particular, where people really started paying more attention to this area. And so there's been a lot of innovation so far. Where do we kind of go from here, though, in terms of, like, you focus on earlier companies, so what are they pitching you these days that is actually going to take them to the levels we've seen some of the fintech unicorns today get to?
Well, I think there is a bit of a moment now where people are worried about what comes next. You can tell, if I had to pick one theme in fintech over the last 18 months, it would actually be outside of fintech. It would be real estate. Mm-hmm. You know, if you think about where the most recent 5 or 6 sort of unicorns were born, not counting Brex, real estate tech was a large part of it. And it really feels like people were stretching, frankly, to accommodate real estate within fintech to try to make the thing feel a little bigger than it was. So we have a point of view on that, but I would say that is thematically appropriate, that where you're gonna see the next 10 years of fintech is gonna be a little more as an ingredient brand within other industries. Mm-hmm. So real estate is part of fintech to the extent to which the real estate stuff is lending, payments, investment platforms, and insurance. Mm-hmm. And a lot of real estate is that. Right. So I think where we're headed is fintech within healthcare, fintech within travel, fintech within transportation.
Got it. So would you consider WeWork a fintech company now?
I certainly tried to convince my investment committee of that unsuccessfully 4 years ago. I mean, that's a true story. I brought WeWork to committee in the kind of low billions and got shot down in part because my partners, we have a big thing internally about sort of why us. Mm-hmm. And so their point was like, why us? Why you, Matt? You're a fintech guy. This is a real estate company. And that led me to sort of do some work on the ways in which real estate and fintech can overlap. At the end of the day, the answer is no. Real estate has a lot of fintech type problems. WeWork is a time arbitrage company. Mm-hmm. And I think there's a big opportunity in real estate around time arbitrage, and they're obviously leading within commercial in that. There's some fintech aspects, but I don't think it's a fintech company.
When did you finally convince your board that real estate should be included in fintech? Like, what did you say?
Well, I mean, I really highlighted, I think Opendoor is a fintech company.
Yeah.
I think the Resi transaction is a bundle of a loan, a commerce transaction, and several types of insurance. Mm-hmm. So, the commerce aspects of it are mildly fintechy, but the rest of it is hardcore fintech. And if you think about what Opendoor has done, it's around transforming that transaction, the timing and movement and valuation, and all those financial aspects. So I think our rough math is that 70% of prop tech is fintech so far. Okay. Our most recent investment is a prop tech deal that's only vaguely fintech, and I got to spread my wings, Julie. But I think the bulk of real estate tech so far has been fintech, and that's not true of healthcare. Mm-hmm. 10% of healthcare is fintech related. Is
part of this just because you feel like there's less to invest in other areas of fintech right now, that you wanted to expand outside of that so you did have more opportunity of things to look at and not miss out on the next WeWork?
There's empirically less to invest in. Yeah. In early stage fintech. I mean, we're seeing huge, gaudy, late stage valuations and large rounds. But if you look at Series A trends, for instance, within payments, mm-hmm. it's off markedly from 5 years ago. It's even worse in lending. There are fewer companies getting created in what had historically been the core 2 segments of fintech in 2019 than in 2014. Mm-hmm. There are probably incrementally more in insurance, and there's probably the same amount in kind of investing, asset management, wealth management. But we now have scale businesses in most aspects of payments that are doing a really good job. Like a very few entrepreneurs wake up in the morning and say, oh, man, Stripe is massively vulnerable. Let's take those guys down. I mean, I think I like the ambition of that statement, and I hope people do start thinking about that. But the fact is, it was easier to say that about First Data 10 years ago than it is to say that about Stripe or Square or PayPal today. And so I think that's having an impact.
Got it. So what % of your investing now would you say is more real estate related versus other areas of fintech? And how has that evolved over the past 2 years?
Last 4 deals we've done, 2 real estate, one a new Series A in payments, which I'm excited about. It had been 8 years since I'd done a Series A in payments.
There you go. What convinced you about them that they should be the one to break that trend?
They're taking on Stripe.
Oh,
So
how are they taking on Stripe? I thought you just said that taking on Stripe was not a good idea.
You have to do things at the Series A that aren't good ideas. I mean, that seem improbable, that seem wildly contrarian, that are likely to fail.
If Matt ever gives you money now at a Series A, you're gonna be like, wait, does this mean he thinks we're a bad idea?
Yeah, it's a mixed blessing in many ways, taking money from me at the Series A. But no, I mean, it means that you have a level of audacity that means what you're doing is unlikely to succeed. Because otherwise, if it makes too much sense, and then you're not gonna change the world for sure.
And I would feel like if it makes so much sense, then it's really easy for the incumbents to tell themselves it makes a lot of sense and just quickly start devoting a lot of money and effort to that and eventually perhaps overturn what they're doing.
Them and 17 other startups. And
yeah.
So, we another one is a company called Alice in the pre-tax spending space, which everybody hates pre-tax spending. Everyone hates that process of going in and dedicating money to your FSA and use it or lose it, and am I really going to spend that? And they figured out a way to do it after the fact. You just go spend what you want to spend. They notice what you spent it on, and they can retroactively pull it out of your paycheck. Unbelievably hard thing to do.
How do you retroactively pull that out of your paycheck? Like one of the final paychecks of the year, you pull that out, or?
It's more timely than that, but you have the full year for sure.
Got it.
But as long as they can recognize it within that calendar year, you can get the benefits of the pre-tax spending on commuter, on healthcare, on childcare, things like that. Much of which in our modern financial infrastructure, actually, you can tell after the fact what you spent on.
What happens if you leave that job after that year when you're supposed to start paying it back and it's supposed to come out of your paycheck? Or maybe I'm misunderstanding this.
No. They can do any of that stuff as long as it's before you file your taxes.
Okay, got it.
It just reclasses your income from taxable to non-taxable.
Got it.
So again, really hard thing to do. That if you went to WageWorks, who's the incumbent competitor, and said, hey, this company wants to do that, they would scoff and say, well, good luck. You think we haven't thought of that? It's like an impossible thing to do.
Right.
And it may be an impossible thing to do, but so far,
Using this thing right here.
What's that? Yeah, exactly. Wouldn't you be happy to get rid of that? I mean, WageWorks makes money on interchange, so they want you to load money onto a card and use that card to spend because they make 150 basis points when you do that.
If I forget to use the card and I go in and file a claim later with the receipt, that's like their worst case scenario, basically, right? Because you wouldn't get the interchange.
They don't monetize that.
Maybe I should just do that, just to be like, WageWorks, you don't deserve my money. You're scoffing at me.
I think that's such a Julie thing to say and do. Most people wouldn't have the energy for that, but I actually think you could do that.
Usually I just forget to have the card with me and I have to end up doing that anyways. But now I might feel slightly better about that process of logging in online, taking a screenshot of the receipt, and sending it on through.
A vengeful Julie is a fun Julie. I think
you know what?
Do more.
You got to have some fun sometimes. So back to the one that's competing with Stripe, though. How do you compete with Stripe? Because we had a dinner last night and everyone was kind of saying, like, there's not really ever been a negative story written about Stripe. It's one of these companies that has grown to a massive scale and has kind of escaped that so far. Whereas a lot of the ones that have gotten that far, like Robinhood, Credit Karma's actually done fairly well too. WeWork has seen a slew of bad stories at this point. How do you compete with Stripe then?
So, I mean, the reason you haven't seen bad stories, it's an incredibly well-run company. I mean, they just have this dream management team. Their customers are delighted. So our theory of the case in payments is that there really won't be interesting payments companies in the future, that all of your payments will be intermediated by software. And so if you're, the yoga studio right now, that's a WorldPay customer or a Stripe customer, you will just be a MindBody customer. You will have software that runs your yoga studio, and your payments will be tightly integrated into that. And as far as you know, your payments vendor will be MindBody. And if you're a plumber, you're using software to do your invoicing, to do your scheduling, to do your inventory management, you will do your payments through that software package. Right now, Stripe, it does integrate through Stripe Connect into those software packages, but not as tightly as they could, because they themselves remain the payments company. What if those software companies could become payments companies, skipping over the Stripe layer and going straight down to the bare metal Wells Fargo layer, keeping all the economics for themselves? I think that would be challenging for Stripe. They could lower price to try to compete, but I think sophisticated software companies are going to want to actually be payments companies. 40% of MindBody's revenue comes from payments now, up from 0 5 years ago. And other software companies are like, wow, that is material. So I think that's an area of vulnerability, even for the best run company, if somebody's just going to overthrow your economic model and empower your customers to not need you at all.
Right.
So again, in the category of high audacity, maybe even improbable, but to me, that's a potential Achilles heel.
Got it. So have you convinced your board that you like health insurance or other sort of health-related things should be part of fintech yet, or is that still an ongoing process?
First of all, I love that you refer to my partners as my board, and they will definitely see the video of this, and I guess that kind of makes me almost a CEO, so I'll take it.
There you go.
No, I mean, we have a healthcare practice that's like incredibly sophisticated. They bring me in to opine on things that are at the intersection. I would say healthcare payments probably falls to me. We have a company called Flywire that got started in higher ed, but now has a large business in healthcare payments, and I think I'm useful in that. Healthcare insurance, though, is a very different field of endeavor. I mean, we think about insurance as property casualty is fintech, life and annuity is fintech, health, the third major category of insurance, is definitely not fintech. But we have a small enough partnership that we can collaborate on this stuff.
Got it. So going back to the pipeline part of it, one other thing I've noticed about a lot of these earlier stage companies is that if there is somewhat of a later stage competitor that is doing really well or raising a lot of money, it can inflate the valuation that these companies are getting offered in various term sheets. How have you sort of managed that? Because you don't want to miss out on things, but you also don't want to overpay for something either, where you're starting off, getting a bad share price.
Yeah. I've stopped worrying about valuation. I spent a lot of my career obsessing about valuation because, literally, what we're supposed to do is like buy low and sell high. That's relatively kind of definitionally the job. But it turns out that if you focus too much on the buy low, you're going to miss all of the sell high. And so I would say I'm no longer complaining about valuation.
To what extent, though? Like, how much higher can it actually be than what you think it's worth for you to still want to get in on that company?
50% higher?
Okay.
I mean, it's just, at the early stage, it's, can we own enough of a company? And whether I have to pay $9 million to own that percentage, or $12 million to own that percentage, or $15 million to own that percentage, like, the ceiling has been raised. Now, I'm aware that, like, the ceiling could get lowered again, but the ceiling has been raised in terms of the upside of venture-backed companies. And, it used to be extremely rare for a company to be worth more than $500 million. And I'm not just talking about private valuations. Now, we've had a bunch of these companies go public. The Workdays, the Tableaus, Twilio, DocuSign, these are companies worth $10 to $50 billion that were venture-backed within the last 10 years. And so I think we've had to reframe what's within the normal distribution of outcome. And that means that if you own 20% of Tableau, that's worth $3 billion, $3.5 billion as of this week. I don't think you're saying, like, I can't believe I stretched to 60 million post on a Series A. You're absolutely delighted. So you can obviously take this too far. And
it's different for growth investors, I would assume, since you're getting in at a different stage at that point.
We worry more about valuation on the growth side, to be honest.
Yeah. I would think that growth you worry more because you're farther along and there's less room for it to run. Whereas if you're getting in early, there's so much upside potential that's there.
Yeah, certainly you can believe that there is.
Yes.
But so in the early stage side, we really obsess about percentage ownership, not to the detriment of the interests of the entrepreneur, but we think about opportunities where we can be useful enough to justify owning a large chunk of a company at the Series A. And then on growth, we really have to be more thoughtful about absolute value as well as, quote, relative value relative to financial performance, because you can be in Tableau having paid $5 or $6 billion and have this week happen and it's still kind of a ho-hum thing if you held it for a long time. So absolute value matters a lot at growth. But I think we've tried to move our mindset to just what are the absolute best companies and how can we be involved versus not involved?
How do you measure best at this point? Like, what are some of the things that are going to be a signal to you, whether it be an addressable market, the founders, areas for growth that make it so, like, like this is one where we would go 50% above what we think it's worth just because we think eventually it's going to get there. It's got a lot of room to run.
So there's some obvious stuff around management and market, but I would say the less obvious stuff is really distinctive. Really hard to do.
Okay.
So I think Brex is timely, raised a huge round at a huge price this week. They're doing something really hard. I mean, I've done a lot of work in commercial payments, and almost all the companies are focused kind of on the rails, and they've really focused on the integration of credit and payments in a way that historically truly only banks and Amex could do, and a lot of startups have shied away from, and they leaned into it, and it's hard to do. Capital is a weapon, valuation is a weapon. They've just done a lot of things right. So can I look at that 2.6 billion and say like, absolutely, that pencils out? Probably not. I don't know the numbers, but I get why somebody really smart like Mary Meeker said, you know what, we have to stretch here. Because if these guys win, it's not just a market size thing, it's a profit pool thing. Like if these guys win, the pot of gold at the end of the rainbow is meaningful and defensible.
Right. Yeah, and there were higher term sheets on the table that might not have had the best of terms, so they went with something lower than what those were. So, I mean, that could have been like a $3 billion valuation and it's 2 years old. Like, there's definitely some stretching, like you say, going on over there.
Yeah, look, I mean, this is the fundamental question that we obsess about is whether this is all cyclical or whether it's actually now secular, which is to say tech in financial services, what we're here to talk about, but tech in every industry. Is this like we're 10 years into a 50-year process of transformation, in which case every deal we passed on valuation, we were dumb? Or is it like the rest of human history where this thing's going to teeter and fall over and we're going to be like in 2001 through 2005, licking our wounds and being extremely regretful?
Right.
If you believed as though it was cyclical, you've already missed a lot of opportunity. And so I think we're trying to be agnostic on that topic. We're trying to live as though it might be a secular thing, because there's evidence it is a secular thing, right. Without being irresponsible. That's the tension.
Got it. All right, so we have 1 minute left. We're gonna do the over-underrated thing, which you can add some context if you feel like you need to, but it's largely just I say something, you say over or underrated. And equal rated is not an answer. They tried pulling that over on the other stage.
Not in
not
Julie
gonna
world.
cut it.
That doesn't count.
Not gonna cut
So
it.
I can't have any commentary or any
You can have
hedging.
some commentary if you feel like it's needed, but we gotta keep it short and sweet. So, American Express.
Underrated.
Challenger banks.
Overrated.
Fair. I want context on that one. Why are they overrated?
There has been a very low propensity for people in any country to move their primary banking relationship to other banks or these challenger banks. And yet, I think the aggregate valuation of them assumes that there's going to be a major shift in consumer behavior. And I'm an investor in Acorns and a very happy investor in Acorns, and I see the numbers and it's happening, but it, in aggregate, has to happen to the tune of tens of millions of Americans who shut down their Bank of America accounts. And I think that's going to take a while.
Yeah. When I was talking to Frank, he made the good point of like, Citi might say, hey, we'll give you $300 to switch over and use this. And it kind of works to a certain extent sometimes, but being able to say like, hey, get paid early, or hey, here you can like section things off more and go more by verticals. Like having more of a tech value proposition can sometimes change that dynamic a little bit.
Well, there's two things in there. Going vertical, which is Frank's big thing, that's a tech thing, and no big bank can do that. Getting paid early is not a tech thing, that's a risk thing, and banks can absolutely do that.
Right.
Notwithstanding the overdraft profit pool dynamics, they can absolutely do that if they want.
Stripe.
I think they're underrated because of Atlas, which nobody really talks about, but like some huge chunk of companies get incorporated now through Stripe. And if you believe the future of commerce is going to be dominated by Amazon and a few others, then Stripe is overrated. If you believe that the future of commerce is going to be continually 1,000 flowers blooming, that we are in an age of entrepreneurship globally with lots of small companies growing fast, then Stripe is underrated because they have like dominant market share at company formation stage.
Got it. Cryptocurrency, last one.
Bitcoin is underrated. I think anyone who doesn't own Bitcoin is being irresponsible.
Really?
Yeah.
That's a shocker for me. I didn't think you were going to give that answer. You can tell me more about it backstage since we are out of time. But that surprised me. Thank you, guys. I think you are free to go to lunch. Jonathan's going to come back on, and we're good.